Do you know that top 1%'s effective tax rate is only 25%? That is lower than majority of the people who is making $160,000 to $300,000, which is really the middle class now in the US with this crazy inflation. What is their secret? Welcome back to our channel. This is Elisa Zhang. In today's video, we're going to look at how you can pay less tax legally by investing in real estate, so that your money can work harder so you don't have to. Average effective tax in America for a single person is 22.4%, but most of the middle class is at 22% of bracket to 35%. How do you keep more of your money in your pocket so that you can invest it and then your money can work harder for you? First step to prepare yourself to save more tax is to find the right expert, and that is your CPA. The money that you pay to your CPA, you should really view this as an investment. Of course, you wouldn't invest in the lousy investment. So why would you pay very little to find a tax expert who can barely file your tax return? You want to hire someone who is going to be in your corner, who is focused on strategy. Here are a few things to consider when you hire a CPA. First, you need to make sure your CPA is specialized in the field of investment that you're in. For me, that is real estate investing. So therefore, my CPA has to be an expert in real estate investing. Second is you probably want to ask around for referral. What is a good CPA? But ask people who is actually in the same business line as you are, doing the same investments as you are. And you want to make sure that your CPA are expert of handling audits. Because let's face it, audits are happening randomly by IRS. Sure, some people has higher audit risk than the rest of us, but really it's a random selection. So therefore, you want to make sure you hire someone, should you be audited, has a track record or successfully defend you against audit. Making sure your CPA actually has a team to support him or her. This is important, because if your CPA is just him or herself, what happens when they are sick? What happens something happened to them? What happened is they simply decided they want to go FI early. And you would not have a CPA working for you anymore, and you don't have a backup plan. But a CPA that has a firm support him or her is going to have more wealth of knowledge in different areas that maybe he is not expert in because he has a team to support him. More importantly, is that your tax will be filed on time, which reduce your audit risk. Now, second step is to invest in something that is passive. Now, let's use real estate as an example. In real estate investment, a lot of that is passive. I'm not talking about fix and flippers. That is actually an active activity. I'm talking about people who's doing boring things. Boring investment are the best investment. That is people who owns buy and hold rentals. Rentals are passive incomes. This means your rents that is coming in is passive income. And there is this magical thing called a depreciation. When you invest in real estate, there's a very few other assets that where you can get depreciations from. But real estate is one of the reasons why everybody all over the world still looking to invest in America, particularly in real estate. So depreciation is basically, simply put, is a paper loss. What does that mean? For example, your fridge that would cost you $1,000 to buy, this is actually considered by IRS a loss. And depreciation is saying that during the lifespan of this project, this cost of fridge could be now further divided into each year, so that the idea is that 27.5 years later, your fridge is no longer lasting, and therefore the value of the fridge is completely depreciated over these time and should be linearly divided between 27.5 years. Why 27.5 years? A linear depreciation schedule for residential real estate is 27 years. That including your apartments, single family home where people kind of resides in. For commercial properties, that's 39 years. So here's another reason investing in apartments or residential investment gives you a little bit more kick into tax depreciation. So more loss, good thing, less tax. Let's return back to our fridge scenario. $1,000 of a fridge If we're using a linear depreciation method that's 27.5 years, you divide it evenly by 27.5 years. What is that? Probably about $36 negative paper loss on your tax return. Let's say you made $1,000 profit after mortgage and everything else. You made $1,000 back. And so in this case, what you're responsible to pay tax on for the profit is $1,000 minus that $36 depreciated from your fridge. Your fridge is still working, but you're able to deduct that loss from the gain. Therefore, your capital gain is only $964, not $1,000 anymore. Pretty powerful stuff, right? Now let's kick it up a notch. We talked about depreciation. Now let's talk about this special concept of bonus depreciation, accelerated depreciation. So what is accelerated depreciation? Imagine your fridge. Again, we're coming back to that fridge. That fridge is actually not going to last 27.5 years. Maybe a few of them would, but most of the fridge in my house never lasted more than 10 years. In fact, by IRS standard, the appliance's age is about 5 years. So therefore, in IRS opinion, your fridge typically only lasts 5 years. Therefore, if after 5 years that appliance has no value anymore, shouldn't you depreciate that appliance value with the years in service instead? So instead of depreciating 27.5 years, your depreciation at IRS defined 5-year schedule. Now, you do the math. If I was able to depreciate $1,000 refrigeration cost in 27.5 years, that's about $36. If I can depreciate a 5-year, that is $200 per year. A lot more, right? That's like 7 times more. So of course you're going to take more losses because more losses means more money in your pocket. So this is what we call accelerated depreciation. Typically, you can't just say, hey, I'm accelerated depreciating these objects. Perhaps your CPA can do some simple ones, but there are companies out there that does something called a cost segregation study, which simply put, they have a team of engineers come and examine your house. Sometimes they can even do virtual tours to decide what are different buckets of things that you have in your house. And then any of these can be potentially depreciated at different age. Appliances is 5 years, flooring maybe 10 years, and so on and so forth. Then they create this report, which you can give it to your CPA, and then they can apply the depreciation schedule appropriately. Now, lastly, bonus depreciation is something a little bit more special over here. This rule was passed in 2017 September, and the rule basically said now the things that are depreciated, deemed by IRS depreciable between 5 to 15 years, some of these can be taken all at first year when you acquire the property and when that improvement has been put into service. So therefore, it's even better, instead of taking that fridge for 5 years loss, which is $200, you can take that all at first year. That's negative $1,000 all at same year. And if you made a profit that year for $1,000, you just reached a zero profit. Mind blowing. And doesn't matter what your tax rate is on that. A tax rate of 20% of zero is still zero. And therefore you pay $0 on that particular $1,000 profit. Isn't that cool? Now, the last stage of where magic really happens with real estate investing is once a few of us become real estate professionals. Real estate professional is not just something that you say, oh, I'm a real estate professional. It is actually a specific carved out class for IRS filing. So you have to be someone who's worked 750 hours in the bucket of services the IRS deemed real estate professionals, or you're spending more than 50% of your time working in real estate related project, whichever is more. So for example, I'm sorry, our full-time employees, it's very unlikely you're going to be able to qualify for this bucket. But that being said, we always believe in that you design your life the way that you want it to be. So who's to say when you're ready to semi-retire, when you get into a part-time gig or turning full-time gig into a consultation, you can reduce your hour at your full-time jobs and become a real estate professional full time. At that point, you may have a better chance to qualify for that. Now, we're not the tax experts, so we're not CPAs. You should definitely consult a CPA to determine if you qualify for that. This is definitely a tricky one. In any case, if you are a real estate professional and you're spending substantial time, which means 500 hours on projects that you're actively managing, or owning 5% or more of the company that's actively engaged in real estate professional qualified activities and making decisions on projects, such as me, myself, a syndicator, then you can possibly taking the passive losses, which what I mentioned before, like depreciation, etc., and using that to actually offset your active income. Now, if you're a high earner, your active income tax bracket can be really, really high. If you live in California, in New York, you may be even paying higher taxes than maybe 50% of bracket. It's ridiculous. So you could potentially use your passive losses to defer your ordinary income taxes. So if you are a real estate syndicator who runs your own projects, if you're a property manager, potentially, if you buy and hold owner that you manage your investment and have decision rights over you may qualify for this. So definitely consult your CPA to make sure that you're taking advantages of all these tax saving strategies. We actually have wrote a blog post with very detailed mathematic examples documenting my personal experience to save these tasks because I have done it. Therefore, I know these strategies really work. We also have another awesome video where we got a 1031 exchange facilitator, a CPA, a tax lawyer, and a cost segregation expert together and talked about different ways that defer capital gains using capital losses. If you like this content, please like this video below and subscribe to our channel to receive future content on money smarts and share with your friends and family.